This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
As I said before break, although what we did in chapter 15 can be asked, far more important and what will definitely be asked are cost of capital calculations. Last time we did investment appraisal where we were discounting, but every question we did last time you were told the cost of money, and if the cost of money was 10% you discounted at 10%. But the question is, where did that come from? The problem being for a company that companies borrow money potentially from two places. They can either borrow money from shareholders, and although obviously they're not paying interest, shareholders do want a return, you're going to have to pay them a dividend, or they can borrow money from debt, whether it's a straight loan from the bank or whether it's issuing loan stock, debentures, etc. And of course then they are paying interest. Or of course, most likely, they borrow money from both sources. Some of the money from shareholders, some of the money from long-term borrowing. All right? And so it's a question of how are we going to calculate the cost of money for a company. Okay? Now, as I say, there are, in fact, a lot of different things could be involved here. I think you'll agree as we go through, most, if not all, of the calculations are relatively easy. Well, all I can do is go through them. When we've gone through them, then I can give you a question, an exam question, and show you how the problem isn't each individual bit, it's putting them all together. Okay? So, let's start working through chapter 17. Let's look at the cost of money, and let's first of all look at the two separately. Let's look first of all at how we can calculate the cost of shareholder money or the cost of equity. All right? So I want to get the two separate and then we'll put them together. So cost of equity. Always what we're looking at here is a quoted company. And of course, thinking back to what we had before break, if we have a quoted company, we know what the share price is because it's quoted on the stock exchange, it's published in the newspapers. But why is the share price what it is? In theory, always the share price was what we said before break. It was based on the dividends they expect and the return they require. All right? Well, what I need to know, if we're borrowing money from shareholders, I need to know what return do they want. Because if they want 10%, we're going to have to give them 10%. That's what it's costing us. But how can we find out what return shareholders want? We can hardly send around a letter saying what return do you want, sort of thing. We effectively work backwards. To show you what I mean rather than talk any more, look at example 1, and again the first one, a very baby one. We're a quoted company and SPLC has in issue $1 shares, so $1's the nominal value, of course. We quoted, so we know the market value. Currently on the stock exchange it's $2.40 a share. They're paying a constant dividend of 30 cents. And what we need to know is what return are shareholders requiring. Well, we simply work backwards. Before break, in that earlier chapter, we had the situation where we knew the dividend, we knew their required return, and we worked out market value. Yep. Oh, exactly the same logic the other way round. We know the market value, we know the dividend they're expecting, and therefore we can work out the required return. And here, again, because it's a baby one, I hope it's common sense. At the moment, shareholders are prepared to pay £2.40. They're expecting to get back a dividend of 30 cents a share. And therefore, what return are shareholders actually getting? Anybody? If you invest £2.40 and you're getting 30 cents a year back, what return, effectively? What rate of interest? I think she's right. Shout if it doesn't make sense. I'm going to give you a formula later, but again, this baby one, it shouldn't be a question of a formula. We say the shareholders' required return again, I'll work in cents, I just think it's more obvious. But they're going to get back 30 cents a year. They're prepared to pay 240. It must mean that they're currently requiring a return of, Vita was right, do we all agree 12.5? I mean, the arithmetic obvious, but is everybody clear about the logic? Now, a couple of things I must say before we make it a bit more exciting. It must mean that currently they want 12.5%. Bless you. Because remember, it's shareholders of fixed market value. If they were wanting 15%, the market value would be different. You agree? The market value always is the dividend they expect and the rate of return they require. So I say again, I'm sorry repeating, but if they'd have wanted 15%, do you all agree? The share price, I can do it in my head, for 15%, the share price would in fact have been $2. The fact that they're prepared to pay $2.40 must mean they're happy with 12.5. Everybody. That's the shareholders' required return. However, we also say, if shareholders want 12.5, we are going to have to pay 12.5. We say, well, that is the cost to the company, the cost of equity. Now, some people here get very upset, and can I make one big point, which will apply all the way through, and I won't need to repeat. Some people say, well, these are dollar shares. You know, the shares may have been first issued 10 years ago. And maybe when I issued them, people paid $1 for them. Yeah? I don't know, but let's assume. Let's assume when I issued the shares 10 years ago, I received $1, and we're now paying 30 cents a year. Of course, if I raised $1 and I'm paying 30 cents a year, I'm effectively paying 30%. You agree? Well, that's true, but the point is this. The shares I've already issued 10 years ago or whatever, I've got that money presumably has been invested. Whether it's good or bad, that's happened. What I'm really interested in is if I raise more money because I'm doing a new project, how much will it cost me to raise new money? Are you understanding me here? And if I was going to issue new shares, if I was going to raise more money, surely I'm going to have to give the shareholders a good enough return. And my problem is, if I was raising more shares today, how much return would shareholders need on that new money? And the only way I can try and estimate is to say, well, if they're buying shares on the stock exchange today, what return are they needing? To buy them on the stock exchange, they're needing 12.5%. And I say, right, if I'm going to raise new money from shareholders, I'm going to have to pay them 12.5%. Otherwise, why will they buy new shares? They'll buy existing ones on the stock exchange. You see my point? Now, say, it's something I won't need to keep repeating, but do be clear that that 12.5 is, for the moment, our best estimate of the cost of raising more money from shareholders. Now, I only mention it because, you see, the arithmetic's easy, and even though that's a baby one, it never gets particularly hard. And none of you are stupid. You can all learn a few rules and do the arithmetic. But there is that danger, and he could ask about it in the written, that people look back later and they think, well, you know, I understand the arithmetic, but if I borrowed $1 and I'm paying 30 cents, that's 30%, you know? Well, I say again, that's irrelevant. The money I've already raised, presumably, is already invested, and it's too late. What I'm concerned about is if we raise more money today for a new project, how much would it cost me to get it from shareholders? Well, I say again, if they want 12.5% to buy them on the stock exchange, there's no way I'll be able to borrow more money from them unless I give them 12.5%. You see my point? Okay, so arithmetically I hope easy. However, of course, what made that a bit too babyish is that the share price was 240 based on them expecting a constant dividend. And I said before that more likely, of course, if you're buying shares in a company, you'll be expecting a growing dividend. And so, the more likely situation, almost certainly, can you turn over the page to example 2? Same basic idea. This time we've got 50, T has in issue 50... Oh, shit. The exam used to be in English, now it's in American. It shouldn't be 50p. Can it be 50 cents shares, please? P equals C. Sorry, Vita, don't panic. We've got 50 cent shares. Well, there's the nominal value. No particular relevance. The market value, though, is 4.20. A dividend of 40 cents per share has just been paid, but dividends are growing at 6%. Well, again, we're going to work backwards. We knew from earlier today the market value is based on the dividends, the required return. We know the dividends, we know the market value. We're simply going to work backwards. All right? Now then, this morning, when we were working out the market value, there was that formula. P0 is D0, 1 plus G over RE minus G. You remember? And that formula was given on the formula sheet. Effectively, we're going to use exactly the same formula, but we know the market value, we know the dividend and the growth rate. We're going to use the same formula backwards and work out the required return. You with me? Everybody? Well, now you have two choices here. We are simply going to use the same formula, but you are all clear what I mean when I say we'll use it backwards. You know, we know 3 of the figures, we'll work out the other one. You've got two choices. That formula there is given. You either make sure you could sort of rearrange things quickly, you know, to work out RE, or you learn a second formula. That formula can be rearranged as follows. RE, and I have typed it at the front top in fact, it equals D0 times 1 plus G divided by P0 plus G. Now trust me, I'm not going to waste time. But that is exactly the same formula. You understand what I mean when I say rearranged? That's far more likely to be needed in the exam. I've already said it's not very often he asks you for the market value. It's virtually guaranteed, though, that he will ask it this way round. He will want you to work out the shareholder's required return. Well, quite frankly, if I were you, I would learn that. I don't care how fast you are at algebra. I would actually learn it. And in fact, you'll be using it so many times that I think it almost, by the time we finish, becomes automatic. But I do hope I'm making sense here. It is the same formula, but the formula sheet gives it for P0. More likely, you'll be using it to get RE. Okay? Subject to that, though, it is just sticking the figures in. That RE is the shareholder's required rate of return. So in our question, check me here, it's amazing how many people have that formula in front of them, stick the figures in, and end up with a completely wrong answer. It's most peculiar. I always work in cents, as I said, that's up to you. But D0, just like before, is the current dividend, which for example 2 is 40 cents. It's times 1 plus G. Well, here the growth rate G is 6% a year, so times 1.06. Divided by P0. Remember the ex-div market value. And the market value here, 420 cents. Plus G, the growth rate, 0.06. It is then just calculator work. Just one thing, which is where some people end up with a different answer. Some people do that times that and then round it. And then divide and so on. Just put the whole thing in. What I mean is, but check me, 40 times 1.06, 42.4 or something, divide by 420 equals plus 0.06. Will you all make sure you can get it? I get 0.1610. Or 16.10%. And generally in the exam, leave it to 2 decimal places. You would write 16.10. Now, I'm not being rude here, but don't be shy. Did everybody manage to get 16.10? I think you'd agree it's an awful shame to have learnt the formula and put the right figures in and get the wrong answer out. And again, without me repeating the whole story, it must mean that today... You all right there, Andre? Yeah. It must mean that shareholders today are wanting 16.1, and therefore, if shareholders want 16, we're going to need to pay 16. There is the cost of equity finance. Okay? It's easy. I said, all these calculations we're coming to, nearly all of them are very easy. It's just that you'll be doing a lot of them, as you'll see, in one question. All right, just make sure, please. Can you all write down the answer to number 3? Number 3. Everybody? Your faces upset me. Smile if you agree. Shout if you don't, please. Peter's doing neither. Oh, good, that was a smile. Andre? Everybody? No problem, no problem. Okay, and I mean, that's it. It is just simply using a formula. As I've said, it's your choice. Either learn the rearranged formula or make sure you could rearrange it yourself quickly in the middle of the exam. However, just one more thing you could do to make slightly more work. Again, sorry, but you'll always get constant growth in dividends, always. And again, if it were a constant dividend, which is unlikely, constant dividend simply means G is 0, the growth rate. Well, it's the same formula, but if G is 0, well, that's what we had in the first example, yeah? But you'll only ever have constant growth, so it's only ever that formula. The one other thing, though, we could throw in to give you a tiny bit more work is how in real life would you go about getting a growth rate? In real life, of course, the market value is a fact. You look in the newspaper. The current dividends are fact, no question. But the problem is that the market value depends on the rate of growth that shareholders are expecting. You agree? And there's the huge problem. You know, how do you know what growth rate shareholders are expecting? Are they expecting 5? Are they expecting 8? How do you know what to stick in the formula? Oh, well, in real life, it's a huge problem. In the exam, he'll do one of 3 things. If he gives you the growth rate, then, of course, there's no argument. Stick it in, we've finished. However, he can ask you to estimate the growth rate yourself in one of 2 ways. Now, think about this. If I asked you, what growth rate do you expect from La Telecom or something? One thing you might look at is the past dividends and see what the rate of growth was in the past. Would you agree? And if in the past they've been growing at 5% a year, it doesn't mean they'll continue, but clearly that would, if you like, be a starting point. And so the first thing he can do, instead of giving you the growth rate, he could tell you what dividends have been in the past and expect you to use the same growth rate for the future. All right? And have a look at example 4 here. An extract from a question. It's now 2001. X has paid out the following dividends in past years. Well, forgive me, you don't need to write them down, but so that I've got them in front of me. In 1996, they paid in total 28,000. In 97, 29, 98, 32, 99, 31, and in 2000, last year, they paid 33. Okay? Now, of course, I will assume that the number of shares in issue hasn't changed. And so what we're after is what's the rate of growth been in the past. Now, fairly obviously and deliberately here, you can see at a glance, dividends haven't been growing at a constant rate. Do you agree? You know, in the first year it went up a bit, 1,000 on 28. The second year it went up quite a lot, 3,000 on 29. The next year it went down a bit. And then the last year it went up 2 on 31, you know? So the growth rate hasn't been constant. However, all you'd be expected to calculate is what's the average rate of growth per year over that period. All right? So on average, is it 2% a year? On average, is it 10% a year? Well, one way you could do it, you could work out the growth each year. So there it was 1 on 28, whatever percent that comes to. You know, there it was 3 on 29, whatever percent. Are you with me? And you could average them. However, when it's growth rates, it's not an ordinary average. You don't just add them up and divide. It's in fact called a geometric mean. But also, it would actually be wasting time. Because all we need to do is this. On the information you're given, the earliest dividend was 28,000. I want to know the average growth rate. Well, if it was growing at G per annum, would you agree after 1 year it would have grown to that much if it was growing at a fixed rate per year? Do you agree? After 2 years, would you all be happy with that? If it was growing at a constant rate, it would have grown to 1 plus g that times 1 plus g squared. After 3 years, 1 plus g cubed, and so on. If it was growing at a constant rate, each year you'd multiply by 1 plus g. Well, on our dividends there, how many years of growth are there overall? Over the whole period, how many years of growth are there? Be careful, be careful. Although I've given you 5 dividends, it's grown 1 year, 2 year, 3 year, 4 year. So there have been 4 years of growth over the period. Well, if it was growing at g per annum, surely after 4 years it would have grown to 1 plus g to the 4th. Still with me? Well, what has it grown to? It's actually grown to 33,000. Well, there is no argument that even though year by year the growth rate kept changing, if it's gone from 28 to 33, on average, the growth per year is g from that equation. And so the average growth rate, 1 plus g to the power 4, is 33,000 over 28. Or 1 plus g is the 4th root, I don't know what you call it, but you understand the symbol, of 33,000 over 28. Which, will you check me, 33 divided by 28 is 1.17 something. The 4th root, well, in fact, even with an ordinary calculator, it's the square root twice. But if you check me, I think it comes to 1.0419. That's 1 plus g, so g is 0.0419 or 4.19%. All right? Now again, I'm getting very funny faces, so I'm going to stop looking at you. And there is no argument, I'm afraid, although, again, year by year, some years it was growing higher, some years lower. If it has gone from 28 up to 33, on average, it was 4.19% per year. And in the exam, he would then expect you to assume it was 4.1.9 in the future. You'd then stick it in the formula, like we did before. It's exactly like that last example. Ilse? Does your calculator give a different answer?
I'm trying to get the 4th root.
Oh, well, I'll play with your buttons later. Here, in fact, it is easy because the square root twice. All right, well, we'll press buttons later. You're happy about the idea? Here, when it was the 4th root, as I say, you don't actually need a fancy calculator, square root twice. Had there been 5 years of growth, then, of course, the fifth route, you'd have to have a scientific calculator. And you should have one anyway. Although, whenever this has been asked, it's always been 4 years. You know, maybe 1 year you'll upset a lot of people and make it 5 years, and then they're in a mess if they don't have a good calculator. Or if they can't press the buttons, Ilse. But so far, it's always been 4. I mean, it's not that often, but... Am I making sense? I mean, in real life, I wouldn't be terribly happy. You know, just because over those years, on average, it was 4, doesn't mean it's 4 in the future. But as far as the exam's concerned, if he doesn't give you the growth rate, but he gives you past dividends, that's all he'll expect. You'd then stick 4.19 in the formula to get the cost of equity. Okay?